Welcome all to the Node, your place for news, interviews, and education. I am Mike, aka Veteran Crypto, and I'm sure David will be joining me here in a minute. Let's see what we got. Sorry, had an error pop up, but I'm sure it's fine. All right, so I'm hoping that a little pet troll that I got on X shows up. I've been going back and forth about XRP, and it never ceases to amaze me. Just how little most XRP holders understand the tokenomics, the utility, the mechanics of what they invest in. I those of you that watch know that I was in the top 3%, almost the top 2% of XRP holders for years, and sold on the pump and made a good amount of money, and I understand it at a deep level. I mean, I followed the court case, with Judge Torres, every aspect of it. ROUSD, how that, is allocated across, ETH mainnet and the XRPL. And no, don't be embarrassed that start out with XRP. I mean, I did too. It was my largest holding. And initially, the tokenomics, I could see where XRP could potentially have a large valuation initially. But with the way that the tokenomics evolved and the court ruling, it just doesn't hold water anymore. There is absolutely zero reason for a high value XRP other than speculation, other than hype. And that's really what's propping the price up right now. And so I feel bad for people that don't understand that and they just buy into the hype. Literally, they buy into the hype and they're gonna get burned, because if you really think that Ripple would be selling any XRP if they thought it was going to $100, $50, $10,000, all these claims,
no way.
They wouldn't be selling any of it if it was going to that valuation.
There's no chance. There's no chance that it could go anywhere close. Although, I'm taking a look at the price, the price performance, the chart of XRP, and it has broken out. It did break out today.
Absolutely.
So it looks like it could potentially push a little bit higher. Its 200-day moving average is up at $1.75. But even if it does move a little bit higher, does that suddenly mean that it's not a fundamentally flawed token?
No. I mean, there's meme coins that do absolutely dick and fuck all, that pump and dump, and there's all kinds of volatility that you can trade short term, absolutely, and make some money. But buying into XRP long term and just thinking that it's going to go to some crazy valuation and you're going to get rich, overnight, and win Lambo, and you're going to buy an island with all your fellow XRP holders. I was in the community forever. I've heard it all. And all of them are expecting that they're going to get rich because of what Ripple is doing, and they do not understand the hard disconnect between XRP and Ripple. XRP, there was a whole court case on it. XRP is not a security. Thereby, there is no contract between XRP holders and Ripple to where they are by law or have a fiduciary responsibility to XRP holders for them to make money. The price of XRP is pure speculation. And as soon as people figure that out and start selling, if you're not one of the first ones and you keep holding your bags, it's going to be like GameStop. You might have, a good amount of money one day and wake up the next day and have nothing because the smart people sold. So I just suggest, if you're going to hold XRP, when there's pumps, make sure you're taking profits. Get your initial out. That's all.
Don't take screenshots. Take profits instead.
Yes. Good, solid projects that we are looking at, where the tokenomics are such to where the revenue and fees generated by the protocol or by the chain are shared with token holders. Hype, Canton, potentially, if it can get past that equilibrium, where it becomes deflationary. Arrow is another one, just due to the buybacks, the locks, / burns. There's a couple of, what's that?
Tron, for sure.
Tron is another one. Hype. Hype is a good one. So there are projects out there that have good, strong tokenomics that share the revenue that they generate with token holders. Those are the ones that I would be investing in, and I am investing in. Tau is another good one. So anyway, and Ondo, if there's rumors that later this year, supposedly, this is pure speculation, that they're going to take a vote, governance vote, and turn the governance token Ondo into a utility token. So if that happens, potentially that could be bullish for Ondo holders. But as of right now, I sold my Ondo because the tokenomics on Ondo suck, in my opinion. So
yeah, the thing for me, Mike, about this rally that we're experiencing over the last couple of weeks here, really it's been like 6 weeks of rally. The thing that kind of is stuck in the back of my mind is this what a rip your face off bear market rally would look like during a Bitcoin bear market? Like if we are still in a Bitcoin bear, which we are, we would need to get above 98K for the bear market to be, ruled over. So we're still in a Bitcoin bear. The larger technical patterns are still to the downside for BTC. So what would a true bear market rally look like? I think it would look pretty similar to what we're witnessing now, with a bunch of altcoins up 100% in a week, 50% in a week, 30% in a session, 5-10% every day. Bitcoin consolidating its gains, but underneath an important moving average. So Bitcoin's still, below that 200-day moving average. In fact, got rejected at the 200-day moving average last night.
Yep.
So this is what a bear market rally would look like if that's what this is. If it's the start of a new bull, it's definitely too early to tell. But one thing that makes me think that maybe there's a chance this is the start of a new bull is what's going on with stocks. Stocks seem to be just up only. Like, don't you know, stonks only go up, right? Wasn't that from like one of those Reddit forums or something like that? What was it? Wall Street Bets?
I'm not sure, but yeah, I mean, you're right. I mean, anytime that the markets pump like this, any smart investor knows that it's not going to last forever. So they're going to be taking profits, and they're going to want to do something with those profits to get their next fix. They want to get that that next high, and so they're going to go into risk on assets. Potentially go into Bitcoin or some quality alts. To try to take advantage of that. That could be what we're seeing, with a lot of this price movement, plus what we're going to talk about with the markup for the Clarity Act. It's looking like that it's going to be moving forward, here on the 14th. So we'll get into that here in a second. But yeah, Crispy, we've been talking about it for a couple of weeks now. Tron, Hype, Canton, and a couple of other key alts have been outperforming Bitcoin. So yeah, no, that's good that you started a Tron bag. I did the same. It's only a couple $100, nothing crazy, but I wanted to get at least some exposure to it. I'm kind of waiting for a pullback on everything, hoping that happens, so that I can put my dry powder that I've I sold my DAG and I sold my Ondo, so I have a couple grand of dry powder that I want to put into some plus up some of my bags if we get a substantial pullback. So anyway,
so that
let's get into the socials.
There is something to sell in May and go away, and with markets just up only for the last 6-7 weeks or so, we could be getting into that early summer phase where a lot of people might want to realize some of those gains and go away on vacation for a couple of weeks.
Yeah. All right. So if you want to join the chat with Jeff, Crispy, Mr. Zimmy, and the crew, come on over here to YouTube, and you can find us at the Node Network, all one word. Been very, very happy, and thank you all out there for following us and subscribing, because we're actually growing. I keep an eye on other channels to kind of get an idea of the interest in the markets and in our type of content. And a lot of channels are bleeding off subscribers. People are just not interested in crypto, but we're actually growing, little by little. So it's due to all of you out there, and thank you for doing that and helping us grow. But if you want to follow us on X, you can find us at the node_network. And this is where I repost info that I find that I think is of quality, from vetted sources, and also debates and discussions I try to have with people in the community. I try to keep it very professional. I try to keep it to where it's facts, logic. I cite my sources, things like that. But if somebody gets wants to get trolly and stuff like that, then I've played with the best of them. Spent a lot of time in the military, and you got to be expert level troll to get under my skin. So yeah, but keep it coming. I get a good giggle out of it.
Trolls, man, they're fun.
Dude,
sometimes.
I have yet to find somebody that can get me worked up. It's you got to be expert level troll to really get under my skin. And I'll go back and forth. I'll keep posting with somebody until they stop, just because the more attention that I can bring to the conversation and expose, because I mean, almost every time I'll write a paragraph, like in this case, about the disconnect between XRP and Ripple and all the stuff that we talk about. And I'll cite my sources and, and everything. And then of course I'll just get back this smooth brained meme or, freaking, or just, they'll try to insult me or something like that. I'm like, so basically you have absolutely no facts or data to support your thesis on investing in it. Is that what you're trying to say? And it's just, they never have a response because they can't. It's, that's the beauty of whenever you present facts, data, and logic, is they can't, come back with anything.
Well, yeah, but usually what they'll do is they'll get angry, or they'll start calling you names, something like that. It's so interesting to me. Cognitive dissonance is such a strange thing because when you present someone with objective truth, and all that does is make them more entrenched in their wrong-headed position, well, that's cognitive dissonance right there. It's just such an interesting thing. You can present some of the facts, and it will make them believe the lie even more. It's weird, man.
It's so weird, and I've actually had, and it's refreshing because I've had multiple people reach out to me and thank me, because I mean I was screaming from the rooftops when XRP was in the $3 range. I was like, take profits, take profits, take profits, take profits, because it pumped from like 30 something cents, at 10x almost. And I was like, take profits, sell, because it was after the launch of RLUSD. I saw that, 75% of RLUSD isn't even on the XRPL. It's on ETH mainnet. So basically it churned XRP into a super cheap gas token. And so, yeah, I was just like, sell, sell, sell. And some people listened and they reached out to me afterwards and was like, thank you so much for educating me. I was stuck in the echo chamber. Crispy, Crispy's in the chat right now. He was talking about that, he bought into XRP and, and got out, and he's glad that he did. Right here, the storylines, cult-like echo chamber had me so bad. I was there too.
Yeah, that's so true. It really is a cult. That's what it is. It's an echo chamber. It's a cult. You get siloed in all of these different channels on X and YouTube that will only tell you a bunch of bullshit about XRP. And the more that you learn about Ripple Labs, and the founders, it's just like, it's kind of a gross story. Like how much they've just grifted off of people who believe in their story. Yeah, not a fan. Not a fan at all.
No, and trust me, I mean, I think that Ripple is probably going to do, and the XRPL is going to do very, very well. That in no way is going to help XRP holders.
I actually agree. I don't see anything being built on the XRP ledger. Nothing that's like retail facing anyway. There might be like
Not
institutional
retail
stuff,
facing, but
but
there's a decent amount. If you go to rwa.xyz, it has been climbing very nicely when it comes to RWAs and things like that. But if you look at the data at XRP scan, it's just flat. There's nothing going on with it. But there is things being built out on it. But again, regardless, it could end up being the Amazon of blockchains. There is nothing in the tokenomics that requires that XRP be any price. It costs 0.00001 XRP per transaction. It was what everyone was so bullish on, that it had cheap gas fees. It was fast and cheap. And it is. 100% is. But that is terrible for token holders because XRP isn't used for the movement of value anymore. RLUSD is. No institution or bank wants to use a volatile asset to move value. They potentially could lose money during the transaction. That's why Ripple launched
Mike,
USD.
I thought that XRP was going to $10,000, man. What are you talking about? That's what I thought.
I know. And if it was, why in the hell would Ripple sell even a single XRP token?
If they sell because they need to finance their operations. Yep. Because they don't actually have any products that really make any money, except for that stablecoin.
Bullish, polish on XRP is because the higher they can get the price to go up, the more that they can offload their XRP for to fund their operations.
Exactly.
That's it.
All
right. Enough about that. So, if you want to check out our official website, thenode.pro, this is where you can find everything. If you want to schedule your no-cost initial consultation with David for coaching, that you can do that here. If you want to shop our store, so we have merch now, hoodies, t-shirts, thermoses, stuff like that. You want to help support the channel, we greatly appreciate it. The newsletter is only $20 a month, 66 cents a day. And you can get, and I'll show it to you here in a second, but we have a ton of no cost value. So DeFi University is a full curriculum from beginner to advanced, teaching you everything about traditional finance, banking, fiat, crypto, wallets, DeFi, beginner to advanced strategies, all of it. No cost, no gimmicks. All you got to do is sign up and learn. It has quizzes, everything. So I highly suggest you do that. If you want our programming, there's the whole calendar here. So you can see we have multiple live calls per day. So, of course, every day, Monday through Friday, we have the node, from 9 a.m. to 11 a.m. Pacific time. The blockchain report on Mondays, Wednesdays, and Thursdays. Those are pre-records with Jeff where he does deep dives into very new projects. We have Monday through Friday at 1 p.m. Pacific, 4 p.m. Eastern. David does his market wrap-up where he does about 15 to 20 minutes of charts and technical analysis. And so if you want him to look at your project, then tune in on the YouTube and jump in the chat and ask them to take a look at your project. And then we have our evening shows. So we have Crypto and Chill on Tuesdays and Fridays. That's where me and Jeff just hang out, have drinks, and just kind of talk about, over the past couple of days, what's been going on in crypto, and in life. And then Saturdays, we have Sovereign Soil. That is my solo show where I talk about emergency preparedness and homesteading. I'm actually working on a project right now where I'm going to expand the homestead with my brother Taylor. He's going to be building out a home here on the property, and we're going to greatly increase the footprint and capabilities of the homestead here. The last episode I did this weekend was on firearms, selecting the right firearms for emergency preparedness. So if you're into firearms, check that out. Saturday Night Fever. That is Jeff He does interviews, tutorials, and sometimes just spins music. So if you're into the mixing and DJ music, check that out. And then gaming and chill on Wednesdays and Sundays. Sometimes I'll jump on and play like Windrose or Arc Raiders, things like that. Sometimes Jay and Ellie jump on and they play. So kind of a chill place to hang out. If you're into gaming. So plenty of that going on. Like I said, courses. This is where you can find DeFi University, go through the courses, the community. If you want to join our no-cost Discord, you can join that here. We are launching a separate paid Discord and YouTube where we're going to have different tiers of membership to where we're going to offer additional content. So, we're a business. We're trying to monetize to help pay for our overhead. All the different softwares and hosting and all the different things that we do. It costs money. For the past like 2 years, we've been paying out of pocket. So we're trying to make it to where at least it's not costing us money to do this. Our charity only goes so far.
Let's get it from cash flow negative to let's just break even on the thing.
Yeah,
that'd be nice.
I'll be happy if we can just break even. So yeah. But we're going to be having some live calls, that are going to be for members only. That's going to have some added value. So go ahead and check that out. The coaching, like I said, you can get a no-cost initial consultation with David, and he can go over, kind of your goals, where you're at currently with your education and your investing, size of your portfolio, all those things, and give you an honest assessment of, what, maybe you need to just go through our no-cost, education first, and then let's have a discussion about, taking you to the next level.
So something that I do with clients. I'm not a financial advisor. I'm not a fiduciary. I'm not licensed in any capacity like that. What I do is I help people build a skill set because it's not easy to operate in DeFi. It's just not, and you need to know what you don't know. And so that's where mentorship and expert help comes in. So if you want to speed up the pace at which you build a skill set, avoid making what can be very expensive mistakes, then go ahead, fill out the form, and schedule some time on my calendar. I'd love to talk to you.
Yeah, no, it's something as simple as not canceling out authorizations that you've done in your wallet. It can expose you to hacks, people draining your wallet, sending it to the wrong address, not having best practices to where we've all done it. And luckily, in my case, it was only like $800 or $1,000 or something like that. A lot better than the the guy that got sandwiched attack and lost tens of millions of dollars.
Oh man,
I mean, that sucks.
But I saw someone just earlier today, Mike, posting on X that they had forgotten to revoke an approval, and their wallet got drained for $200,000.
Yeah.
So you got to really take your security best practices seriously when you're operating in DeFi.
Absolutely. Absolutely. And then here's the newsletter. So it is an AI generated newsletter that, that verifies it's the data and its sources and the information that it gives. But, as always, we give hyperlinks. We give links to everything in the newsletter. So, you can, trust it, but always verify. It's something that I always do. I always try to find 2, 3, 4 different places that are saying from reliable sources that are saying the same thing to make sure that the information that I am storing is accurate. It's what we all should do is base our investing off of good verifiable data. So you can see it went through did it all, and it gives you the inflows, outflows for ETFs. It gives you a snapshot of the assets that you choose. That is what makes this sexy, is you can choose the stocks, commodities, or crypto that you are interested in, not the ones that we select, the ones that you are interested in. And it's going to give you the data and the news for those assets. So it will give you the current price. It will give you, again, links to where you can verify to make sure it's pulling the most up-to-date data. And keep in mind that the free sample is pulled once a day, so it's not going to be real time. Now, if you're paying for it, it's going to be near real time. So next up, ranges. So whenever you're looking at the ranges, it looks like there's no data yet, but whenever it pulls the ranges, you will get trading ranges and liquidity pool ranges. So lines of support and resistance, so that if you want to enter a concentrated liquidity pool for one of your assets, that you have an idea of where those lines of support and resistance are, so that you can pick your range properly and make sure that you're as profitable as possible. We have on-chain data, again, with hyperlinks so that you can verify the data. We have the flows. We have the derivatives. We have whatever the big story is that's trending right now. And, in what's, kind of a deep dive into what's going on with that. Looks like we got A20, Apple strikes historic chip foundry deal with Intel to diversify supply. All right, cool. We got the quick hits. So this is just basically the kind of the top stories that are going on right now, and then usually there's hyperlinks in here so that you can go to the stories and dig deeper. And then finally, there's the node take. So this is what we are seeing currently going on in the markets, what we see happening in the next 12 hours, 24 hours, and 72 hours. So this is just the summarized version, or the breakdown of kind of what the newsletter looks like, so you have an idea of what it's going to give you. The paid version is much more comprehensive. So you got anything to share on that?
Yeah, well, one other thing here. So the trading ranges, the on-chain metrics, it looks like the generation failed for that. Now, one thing that I do have to be able to do before we can like really start to take on clients for that newsletter, I've got to do, it's called hardening. So when you like build a piece of software and then launch it to production, I need to harden the code so that it stops breaking because
it stops changing things on its own.
Yeah, man. I think that sometimes, it's got a mind of its own. I'm not quite sure, but it works. And then a couple of days later, something will fail. So
Yeah.
I need to go through and harden each phase of that newsletter generation pipeline.
Well, and until then, feel free to I think it's like once or twice a day. You can generate the no cost version. So I mean, feel free to to use it. And again, it's the dumbed down version. When the the actual product rolls out, it will be much better product. So yep, check that out.
It's very close.
And then this is what I was talking about when it comes to the merch. We got hoodies, for DeFi University. We're working on some of these designs. I know Jeff last night, he was working on some for Saturday Night Fever and things like that. And then I'm working on some for Sovereign Soil and and some of the other shows. So we'll be updating these. But keep an eye out. I'll be jazzing something up for the Red Pill. I want to have like some actual graphics and stuff on it. But yeah, no, this is coming along. That the hat is what I'm excited about. I need to order one of these so that I can wear it during the show.
Me too.
But that is what we got going on as far as that. So let's dive into the topic. So first off, what do you got for the deep dive later on in the show?
I've got some interesting stuff. So, the first thing is today, this week, actually, we've got a couple of important events. So number one, Kevin Warsh becomes the new Fed chair today. Today's Monday, right? So Kevin Warsh becomes Fed chair today. Tomorrow, we've got CPI. So we're going to get an inflation read tomorrow. And the expectation is that it's going to print a little hot. On Wednesday, we're going to get a speech from the new FOMC chair, Kevin Warsh. So that'll be potentially market moving. On Thursday, we're going to get a read into the Fed's balance sheet. And then on Friday, and this could potentially move markets too, Trump and Xi are going to be meeting. So it's a big, big week. And what I've got for
Well, and
content,
the 14th, they're supposedly doing the markup on the Clarity Act.
right? Yeah, so that'll be important too. And the content that I'm working on right now for the second half of the show, I've got three pieces of content in the works. Number one, because we're getting a new FOMC chair today, and I think that his term lasts for like 12 years, I think, as FOMC chair. I really wanted to learn more about Kevin Warsh. Like, who is he? What's his background? What's his economic policy likely to be as the new chair of the FOMC? So I put together basically like a dossier on him and turned it into a piece of video content. So we're going to go through that. And then because we've got CPI printing tomorrow, and people always talk about Bitcoin being an inflation hedge, I was thinking to myself, well, what has Bitcoin's price performance looked like over the last 6 years after CPI prints? So I put together some research on Bitcoin's price performance after CPI, and we're going to go through that piece of video content. And then the last one that I produced here is, all about the .com bubble. Because when I see these stocks in up only mode for weeks and weeks on end, just all stocks seem to do is go up. And then I take a look at what is going up and why. And it's chip manufacturers, Nvidia, Intel, Apple going up on the heels of a deal with Intel. It just makes me think, okay, well, when have I seen this before? And now I wasn't old enough to be a trader in 1999 and 2000. I was a little kid then, but it certainly does seem like there are interesting parallels between that .com bubble and the AI boom. So put together a piece of research on that. So that's what I've got for us in the second half.
I think there's parallels to be drawn with the crypto industry as well with the .coms, because I was an adult. I mean, I was I'd been in the army for like 6 or 7 years. Yeah, no, like 8 years by that time. I was actually in the Marine Corps. I'd left the army, went to the Marine Corps, and yeah, I remember it vividly. And .coms were everywhere, and people were just throwing money at .coms. Everything was pumping. You could close your eyes and throw a dart at a dartboard, and whatever you hit was going up. If you had all the different .coms on the dartboard, and almost overnight there was the bubble burst, and 95% of the .coms went away, and there was just a couple left. And it was Armageddon. And that's what I see happening with crypto in the not too distant future is, as we move from a speculative market, because that's really, the valuation on some of these freaking projects that have nothing. Here, I'll go and we'll look at the top 10. So the top 10, I use it all the time. XRP, number 4, with a $91 billion valuation. Based on what?
I have no idea. It's got to be based on just some type of long running grift. That's the only thing that really makes sense to me.
Speculation. That's all it is. It's hype and speculation. If you look at Dogecoin, it's a meme coin with almost no utility. They've tried to build out some utility, but at $18 billion valuation, based on what? If you don't understand what I'm talking about, normal like stocks or any kind of investment is based on the valuation of the company and the services or the products that it offers. Because that's what it all boils down to. That is why quarterly, when Amazon and Google and all these different companies come out with with their earnings statements, that's why it moves the price and why it's so valuable to know is that's what's going to move the price, because the price of the stock is correlated for the most part to the valuation and the profitability of the company, because there's a legal contract, because you're buying a stock. They have a fiduciary responsibility to ensure that the company is profitable and that their investors make money. That's they by law they have to. That is why we are always screaming from the rooftops here on the node that yes, crypto is, most of them are not a security. There was a whole, and that's why I use XRP as an example so much, is because the SEC versus Ripple case ruled that XRP is not a security as far as retail is concerned. And so there is no legal contract. It is not a stock in Ripple. It is a gas token. That is it. It is so important that people understand that. And that's not just XRP. There is a bunch of tokens out there in the top 10 and top 20 that are the exact same, that have multi-billion-dollar valuations. It is a bubble. And a lot of these cryptos are going to crash and go to next to nothing.
Mike, I asked myself, I've been asking myself over and over and over again over the last couple of weeks as Bitcoin has continued to rally, but really as we've seen some of these alts just pump, I've been asking myself, what would a legit rip your face off bear market rally out of altcoins look like? And why would it end? And so when I see, all of these different assets, so if I just go down the list real quick and we take a look at, in the top 100, Solana plus 15% this week over the last 7 days anyway. So the numbers that I'm going to read off, this is just over the last 7 days. Yeah. And as we speak, Solana is actually breaking out. It just broke out above a level of resistance at $96.5, $97. It's actually breaking out. And if that breakout continues, well, Solana could move all the way back up. I think its 200-day moving average is quite a ways away at 113, but $13 for Solana is not that much. It could do that quickly. So, when I see Solana, plus 15%, and even Cardano, that garbage project, plus 12%.
That's another perfect example. Name one thing that is built out on Cardano. It has a $10 billion valuation. There is nothing built on Cardano.
It's so much worse than that, though. There's no liquidity in any of the DeFi protocols on Cardano.
There is almost no DeFi to speak of.
It doesn't make any sense. Yeah, but even that's basically a decentralized exchange. MinSwap kind of sucks. All of the protocols on Cardano aren't very good. And one of the things that is just so weird to me is that I think that the entirety of the valuation of the Cardano chain is based on just staked ADA. Because when I take a look at the DeFi protocols, there's no there. There's nothing there. So how can you support a $10 billion valuation when all of the protocols have like maybe $100 million in liquidity? In fact, I think there's only one that's got that. And the rest of them are much, much, much thinner. So nothing going on Cardano, but plus 12% this week. Zcash over the last 7 days, plus 35%. Chainlink, plus
36,
yeah. Chainlink, plus 12%.
Ton is up like 65.
Yeah, man. Ton has really, pushed higher. Sui the other day had it had a 30% session just the other day. Even something like Litecoin, plus 7%. AVAX plus 10%. You take a look at, I don't even know what meme core is, to be honest, but this is a $4.2 billion coin plus 22%. Hedera plus 9%. BitTensor Tau plus 16%. Kronos, that's CRO, plus 13%. Uniswap with the Uni token plus 17%. Mantle plus 9%. We go down the list here. Ondo plus 37%.
And I don't want people to take what we're saying the wrong way. I mean, we're not bearish on crypto, and this isn't just we're not just trying to FUD out people on these projects. Invest whatever you want to invest in, and we can be wrong, and again, it doesn't mean that you can't make money on these, trading them short term, or even holding them for a while and selling the pumps. And there's still ways that you can make money off of them. We are just trying to draw your attention to the fundamentals the tokenomics of these projects and what's actually being built out, not speculation, not in talks with, not thinking about, not doing a pilot, projects that are actually actively being built on and used to move actual value, that are actually being integrated into the traditional finance system, the New York Stock Exchange, the US Treasury, banks, institutions. That is where we are trying to draw your attention to. We want you to be successful. And the best way to do that is to invest in solid projects that those banks and institutions and governments are investing their time, money, resources, and where they are putting their liquidity. That is your best chance. And the best tech doesn't always win. I mean, Cardano, I'm not an expert on it. I'll admit that. I've heard that it's supposed to be, this great tech. Algorand, same thing. I keep hearing what a great tech it is. The best tech doesn't always win. Betamax was better than VHS. Those of you that remember those, it was a better technology than VHS, but VHS won because it was adopted for the most part by the porn industry, which was a majority of the market for VHS tapes back in the day. What's another technology? There's a couple other ones where like it wasn't the best technology that won out. It was anyway, but it's happened time and time again. Where there has been a better technology, but because of adoption, it basically forced the industry to go a different direction. So
it's a bit of a moat. If you've built something and you've got a ton of users, you've got this massive user base, and then one of your competitors comes out with something that's better than the product that you've built, but they don't have anyone using it. Well, are people going to migrate from your product with that massive user base to the better product? Not necessarily. You really would need to build a user base. So, people say that Cardano is good. I don't see that. And when I'm going down the list,
I'm
Mike,
just willing to admit if I don't know something. And
yeah,
I really, other than the tokenomics, and the fact that I know nothing's being built on it, and there's nothing going on it. I mean, it's it's kind of like why go any deeper than that if if as popular as it is, and the market cap that it has, if it's not being adopted, utilized, anything like that, that the buck kind of stops there.
I mean, what I see in markets right now is a bear market rally. That's what I see. And the moment that Bitcoin decides, hey, you know what? That 200-day moving average, I'm going to go ahead and break out above that 200-day moving average. If that's what happens, well, then, hey, if Bitcoin rallies up to 98K, then a bear market canceled. That would be the first time in history that the bear has been so short and the trough has been so shallow.
Oh shit!
So
So
I'm just,
we only got 15 minutes before the deep dives, so we haven't even gotten to the news. Sorry, man.
Let's do the news.
I might need to sign off a little bit early. They're doing some work on the power lines, that feed my property. So I might need to sign off about like 15 minutes before the end of the show. So
All good.
all right, cool. But let's see. Let's get into the institutional front run. So analysts are confirming a 6-week institutional inflow streak, the strongest run since April. Are institutions moving ahead of a regulatory breakthrough? So you might be wondering why institutions are suddenly comfortable pouring hundreds of millions into crypto. Potentially, it's because of May 14th, here this Thursday. So the breaking news is that the Senate Banking Committee has set Thursday, May 14th at 10:30 a.m. Eastern for the executive session markup of the Digital Asset Market Clarity Act, or the Clarity Act. So supposedly why this is the big one. This is being described as the most consequential piece of cryptocurrency legislation ever to reach this stage in Congress. It seeks to settle the years long jurisdiction litigation by drawing a regulatory boundary between the SEC and the CFTC, much of which they've already lined out themselves. As far as what's a security and what's not, and if it's a security, it falls under the SEC. If it's not, it falls under the CFTC, which, handles commodities. So the Polymarket is saying that the passage odds are sitting at 75%. The sticking point so far has been the stablecoin yield compromise. So banks have been saying that they don't want us to be able to just hold stablecoins and earn yield because they want a monopoly on that market. They want our liquidity so that they can lend it out and make money and give us nothing and pay it and make us pay a bunch of fees for the honor of them, holding our liquidity. So, they want to make money, coming and going. So that's what's been holding it up. And then of course, the crypto industry, we want to make money on our money. I don't think that's too much to ask. Why can't we use DeFi and do what banks do with our liquidity and lend it out and, do different things with it, provide liquidity for swaps and, different aspects of DeFi and earn yield. Seems pretty simple.
I think that for the Clarity Act, Mike, that there's something else that's really important here. One of the remaining hurdles in my mind, anyway, is that this to pass is going to require a full 60 votes on the Senate floor. That's going to be the most difficult step because there's a big problem, and that big problem is that President Trump and his family have this crypto empire. And Democrat politicians hate that shit. And so, Kirsten Gillibrand, for example, is likely to pull her support if there are not stricter ethical provisions. I think that
she's publicly said that right. If there isn't if there isn't an ethics clause in there to where Trump and Trump's family and I agree with that. I think that there should be an ethics clause in for stocks and for investments.
I agree 100%.
That draft and pass legislation that dictate or that have inside information on if the SEC is going to be serving a company with a Wells notice or something like that. I don't think they should be able to be investing in stocks because they can front run that information.
Or if the president of the United States is going to be, sending out a post on his Truth Social account and retweeting that out on X, saying, "Hey, we don't like China today, 100% tariffs," and the market's going to dump. And there are people that are trading ahead of that.
Somebody in his family shorts before
$300 million, on Hyperliquid or something. Yeah,
right.
You see that all the time, the time. It happens a lot.
Yeah,
and that's just totally fucked up. And what he did, what the president did with that meme coin, using his audience to launch a meme coin that went down only. It's not even that it went down only; it's that it was launched at all. It's just a bad look. And I just don't see how they're going to be able to pull together 60 votes in the Senate if no Democrat politicians are going to vote for this. So it's going to be interesting to see how they get it across the finish line. But this is the next 48 hours, right? This is the final window required to notice a markup session. So I guess the goal is to have this signed by Independence Day this year. I don't know if that's going to happen. We're going to find out this week. But what if it doesn't? What if it doesn't happen? And the Clarity Act is not able to proceed, and all of these institutions that have been accumulating digital assets just kind of get stuck in limbo. And also, Mike, why is it that these politicians have to try to force this through, get it done now? Because they're going to go campaigning for the next 6 months? Does that mean that they just don't work for 6 months while they're campaining? Is that what that means?
Already only work 180 something days a year because of all the the recesses and vacations and everything else. I mean, what a fucking cake ass job. It's you don't. It basically barely work. there's absolutely the only incentive for them to do any work is to hopefully get reelected. Um, and pretty much that's dictated by whoever they're stroking off. As far as their people that contribute to their campaign.
Right,
So
the
it's usually
donors.
banks and institutions and
Right.
large donors like that. So like they're not beholden to us, and and that job they vote for their own benefits, they vote for their own pay. It's like it's such a ridiculous. It's so ridiculous.
So I
There's
would I
absolutely
would
no incentive for them to do a good job.
what type of job is it where you can go and vote for how much you should get paid? Like,
Right?
I would say, "Hey, yeah, I'd like, maybe a couple $1,000,000 this month. That sounds about right," you know? Like, it just doesn't make any sense at all.
It's
But,
ridiculous.
yeah, I think it really is, and they definitely don't work for us anymore. They
No.
work for, lobbying firms, and they work
Yeah.
for corporate donors, and they're basically bought and paid for.
Well, why
So
do you think the majority of lobbyists are prior politicians? Is because those lobbying firms, they usually promise cush positions like that to politicians if they vote the way that they want them to vote. It's basically a legal way, a legal loophole for them to bribe. Instead of like monetary gain, it's just like, hey, you know what? You're somebody with a unique set of skills. That you network. You know how Washington works. You're a lawyer. You have a legal background. We'd very much like to talk to you about a position making seven figures or eight figures or whatever.
I
After you
mean,
get done with office.
it is true. It is true that those, politicians who left office and joined lobbying firms, they do have a skill set, that's for sure. The
Absolutely.
skill set is how do we navigate this scammy system? That's the skill set.
Well, and
Um,
it's also like I said, it's a legal loophole to where basically they without saying it, it's we want to hire you, wink, wink, as long as whenever we
play
ask,
ball.
yeah, as long as
Yeah.
you play ball,
So here's something about the Clarity Act, though, Mike, that's interesting to me. That jurisdictional split between the CFTC and the SEC, and what those two agencies are going to be regulating. So it looks like the CFTC is going to have exclusive jurisdiction over digital commodity spot markets, while the SEC is going to retain control over investment contracts. And the problem for me is that I'm not convinced that the people who wrote the language for the SEC and CFTC for that joint memo that they released, selecting the Sweet 16 digital commodities, I'm not sure that they actually know what those things are, what those projects do, what the
Mhm.
coins are, like how they operate. Because it looks like, the Sweet 16 was just selected, ad hoc based on whoever donated money for whatever reason.
It looks like they
Because
looked at the top 20 and they selected the top 20 and a lot of more of those ISO tokens, XRP, XLM, the usual suspects,
And somehow Aptos made it in there. Also, there's a couple of meme coins. I think there's two meme coins that made it in there.
right?
Like it seems so unserious to me.
Yeah.
And so that attach detach framework that the CFTC SEC joint statement created, where when you're creating a protocol and it's got a token that, and I'm not even clear on this myself, that token could be considered an investment contract, which makes it a security, which means that if you're going to build a DeFi protocol in the United States and you're a citizen and you care about, complying with the law, then yeah, you're going to need like $1,000,000 just for compliance to be able to
Yeah,
get off the
just
ground,
just a file and go
just
through
to
the
get it off the ground.
yeah,
Yeah.
yeah.
And, I don't see how that spurs innovation.
It
Like
does.
I don't
It
see
drives innovation overseas.
I don't see, yeah, exactly. I think that will drive innovation out of the United States, and probably to Southeast Asia, where people use crypto daily. And
Yeah.
then, the CFTC is going to be regulating digital commodity spot markets. The CFTC needs to make it clear how a lot of those Sweet 16 coins are commodities, because based on their own attach detach framework, I don't think that most of the coins in there qualify as
Well,
digital commodities.
that's always been my question: is what criteria did they use to decide, that Sweet 16? And if there is a set criteria, which I'm sure there has to be, then why wasn't it used for all crypto projects? Why didn't they just publish, the criteria, and anything that meets those criteria is a commodity, and anything that doesn't is a security.
Yeah, so let's find out what were those criteria. Um, let's see here. So the Sweet
Well, well,
16.
while you look that up, I'm going to read this news article on the Clarity Act markup. So, like I said, the stablecoin yield question has been the hangup. So the central obstacle that has stalled the bill for months is resolved. Senators Tillis and Albrook's locked in compromise language 2 weeks ago that bans passive yield on stablecoin balances, but permits activity-based rewards tied to real platform participation. Both sides are unhappy with it, which is typically the signal that a deal is real. Polymarket betters. So basically, what it boils down to is you can't just put stable coins into an account and earn yield off of it. It has to be activity based. So you have to be providing liquidity on a DeFi protocol. You have to be lending it. You have to be doing something with it to be able to earn yield. Based on the current wording of the Clarity Act. If it's passed as written. So that's the long and the short of it is, we're not going to be able to just hold stable coins and earn. You're going to have to do something with it. There's going to have to be some risk, involved with how you use it for you to earn yield on it.
Yeah, so I'm just reading here about the Sweet 16. And so let me just read off what the Sweet 16 are, okay, so that we can just have a chuckle. So Bitcoin, of course, is the only digital commodity. All the rest are not. And here's the rest: Ethereum, Litecoin, Bitcoin Cash. Those three made it into the Sweet 16. Now, here are like the smart contract layer one group: Solana, Cardano, Polkadot, Avalanche, Chainlink, Polygon, Cosmos, and Near Protocol. And then here are the last four: Uniswap, Filecoin, Stellar, and Monero. Now, I need to verify that those 16 are not a hallucination from Google Gemini and that those are actually the correct Sweet 16. But I'm just thinking to myself, how in the world did they select these 16 digital assets to become the only digital commodities officially recognized by the CFTC? Apparently, they went through this clarity test. So there's a 4-pillar framework that the CFTC refers to as the clarity test. And so number one, there's a decentralization threshold. So the asset must not be controlled by a single active group or central entity. So hold on a second. That doesn't make any sense. It can't be controlled by an active group. So how in the world did Ethereum make it on there? Or Solana? Or Cardano? Or Avalanche? Or Chainlink? Or Cosmos? Or Near Protocol? Or Uniswap? Or Stellar? How did those make it on there? Because to me, they would not pass the first pillar of the CFTC's own clarity test. So that's number one. Number two is operational maturity. So the CFTC required that the network have a proven track record to ensure it wasn't a ghost chain. That's so funny that it wasn't a ghost chain. What do you call Cardano? How about Polkadot? What about Cosmos or Near Protocol or Filecoin or Stellar? I would categorize, maybe Stellar a little bit less so, but even that one still, I would categorize Near and Atom and AVAX and Cardano and Polkadot as ghost chains, especially when you compare them to something like Ethereum or Solana. They definitely look like ghost chains when you compare them to something that's really not a ghost chain. And then the third pillar here is utility versus speculation. So the CFTC was looking for consumptive use cases. So an asset had to prove it was being used as more than just a speculative vehicle. Okay, great.
That's easy. That's easy enough. I mean, just simply being a gas token, gives it utility and use. So
And then the last thing here is the absence of information asymmetry. So the CFTC here is saying that unlike securities, where investors rely on management's insider info, digital commodities must have total transparency. So again, I think that the only digital commodity is Bitcoin. That's my opinion here, and I just don't understand how those 16 assets, 15 outside of BTC, how they made it onto that list at all. Doesn't really make sense to me unless the people who are involved heavily with those projects paid to get them on that list. That would make sense to me.
and then that goes, back to what I was talking about, where these, lobbying groups, are able to sway votes, based off of, favors, loopholes, that, because again, you have politicians that draft the legislation that, gets signed into law, that, so they make the rules. And so you think they're not building in rules, or building in loopholes, to the rules to where they can enrich themselves and empower themselves, and the people that are making them rich and powerful and keeping them rich and powerful. You're crazy. I mean, you think that I mean, look at tax laws. Why do you think there's so many loopholes and write-offs for, the wealthy? Is because the people in politics, I mean, they don't go from being, some of them, they go into office where they're in debt and their credit sucks. In a matter of one or two terms, they're multimillionaires. They have $40 million plus.
How does that make sense,
How
right?
does that make sense when they're making
How do you?
175K a year?
It doesn't make any sense at all. And
Exactly.
I want to correct myself from earlier.
Okay.
When I was going through the Sweet 16 list, I thought that there was a hallucination in Google Gemini, and there was. I asked it again, and I got the real list this time. I just want to run through these because I see in
Okay.
the chat people are talking about Filecoin. Filecoin is not on the list. So here's the true list. Bitcoin, the only asset that should even be on there in the first place. So Bitcoin, Ethereum, Solana, Cardano, Avalanche, Polkadot, Aptos. Aptos is a brand new chain. XRP, Stellar, Litecoin, Bitcoin Cash, Chainlink, Hedera, Tezos. I don't even know what Tezos is.
I've never
Dogecoin,
heard of Dara.
and Shiba Inu. So yeah, Hedera H bar.
Oh,
H-bar,
Dara.
yeah,
Oh,
yeah, Hedera, yeah. So those are the Sweet 16. So you've got two, they refer to them as community assets, which just tells me that they really don't understand, what Doge and Sheeb are.
no.
I think that that's some bullshit. And then you've got infrastructure and enterprise. So Chainlink makes sense to be considered infrastructure and enterprise.
Yeah.
Tezos and Hedera, I mean, maybe we just need to do a deep dive on both of those projects to find out, but I don't think so. Payments and utility. This is so funny. This is what made it onto payments and utility. This is from the CFTC. XRP, Stellar, Litecoin, and Bitcoin Cash.
Mhm.
Like, huh? Who uses Litecoin or Bitcoin Cash or Stellar or XRP for payments? And exactly what utility is there for Litecoin and Bitcoin Cash? I don't understand. And then layer one ecosystems, you got Solana, of course, Ethereum, and then you've got Cardano, Avalanche, Polkadot, and Aptos. How did that brand new project Aptos, which is like just a couple of years old, make it onto this list? Why did Polkadot make it onto this list? Avalanche? I mean, Avalanche, okay, but like, how did it make it on the list? Cardano? Why? So I don't know. It just seems like an arbitrarily picked list. And it would not surprise me to learn that, the people who are heavily involved in those projects actually were able to incentivize the rule makers, the regulators to get their projects on that list. Um, and that's some bullshit, man. Because, if it's just a pay to play scheme and it's not real regulation, what does that tell you potentially about what the Clarity Act is going to be? I'm just thinking to myself that the Clarity Act could be a sell the news type event. It
Yeah.
could be. It certainly could be. And speaking of sell the news, I've been waiting to open another short, another Bitcoin short, and I'm just opening a small test position right now because I'm thinking to myself, hey, it's touched that 200-day moving average twice now and gotten rejected both times.
Do,
And so
do you want to do that live and share it, and then we can get
well,
into
I,
the
I
details?
just yeah, I just opened up a little position here, but let's go ahead and which one do you want to move forward with first? Which piece of content do you want to take a look at first? Let me share my screen.
Well, lay out the buffet for me. What do we got to choose from?
All right, here's the buffet.
Yeah, yeah. If you were the waiter, give me the appetizer, the main course, and the dessert.
Okay, so we've got Kevin Warsh, and since he becomes Fed chair today, I put together a dossier on Mr. Warsh. It would be pretty interesting, I think, to learn about him.
Okay.
I've got a piece of content here on the AI boom and the comparison to the dot-com bubble. So, this is definitely going to be an interesting piece of content. And then over here, I've got a little bit of information because we're getting CPI. CPI is going to print tomorrow. So we're going to get an inflation read. And I just wanted to find out, how has Bitcoin, responded to CPI inflation prints in the past when they've come in really hot? So I put together a little bit of research on this. So which of these three do you want to start with, Mike?
Let's do Fed Chair, Bitcoin, AI.
Got it. Okay. So Fed Chair, here we go. Let's learn a little bit here about Fed Chair Kevin Warsh. And let me just go ahead and stop the screen share and start it over again so that I can make sure that we're sharing audio here, because sometimes this, for whatever reason, sometimes it doesn't work the first time. So there we go. Let's go ahead and hit play.
Since 1979, the commanding heights of U.S. monetary policy have been the exclusive domain of PhD macroeconomists. Kevin Warsh's confirmation breaks this 50-year trend, replacing theoretical modeling with the real-time instincts of a Wall Street negotiator. In May 2026, Kevin Warsh officially becomes the 17th chair of the Federal Reserve. He holds a Juris Doctor and a background in mergers and acquisitions at Morgan Stanley, marking a definitive shift in how the world's most powerful central bank interprets economic data. He inherits a macroeconomic landscape under severe stress. Stubborn inflation sits at 3.3%, driven up.
So just real quick, if in the past FOMC chairs have been academics, okay, and this time we've got an FOMC chair who is someone who actually has experience working in this industry, I think right off the bat, that's a big improvement, because academics suck. Like, if you can't do, teach type thing.
Yeah.
And so, the people who have actually done, usually they have better insight into markets than people who just read about them in books.
Upward by energy shocks tied to the ongoing Iran conflict. Simultaneously, Warsh faces an intense pressure campaign from the White House, which is actively demanding immediate, aggressive interest rate cuts, despite that above-target inflation. This political demand for cheap money clashes directly with his historical record. During his previous tenure...
Right, so this is the interesting thing about Kevin Warsh, is that from everything that I know about him so far, Mike, he does not seem like a dove. And my understanding was that President Trump wanted to install a dove, in the FOMC, in the Fed, so that rates could be cut and we could run things super hot. And, you would see growth just go through the roof. But Warsh doesn't sound like a dove. If anything, he sounds more like a hawk to me.
On the Cent board, Warsh built a reputation as a fierce inflation hawk, vehemently opposing Chairman Ben Bernanke's experimental market interventions, specifically the $600 billion quantitative easing program known as QE2.
Imagine being able to just print, $780 billion and hand it out to banks. Well, what Bernanke did in 2008, a lot of people are going to say that, hey, that saved the financial system. Well, maybe so. but it ushered ushered in this era of expanding M2, and that's US M2, the money supply. And so as M2 expands, inflation goes up, and anyone who doesn't own hard assets or make a lot of money is going to fall further and further behind until you get to this point where it becomes almost mathematically impossible that you can raise yourself up out of poverty, basically, because the money is just not worth anything anymore.
Well, and
So
you see it in private credit. Record high levels of credit card debt, and basically people living off credit.
yeah, living off credit and or paycheck to paycheck, something like that, and it's just a horrible existence, man.
Yeah.
To predict how markets will react in 2026, we have to reverse engineer Warsh's exact policy roadmap to understand how he plans to deliver these politically demanded rate cuts without destabilizing the US financial system. The traditional academic central bank evaluates the economy through lagging macro-level aggregates.
Okay, so let's just pause there for a second. This central bank there's a reason why it's always too late, because they're not in the business of using data to try to forecast what's going to happen in the future and acting ahead, based on a forecast. They're always too late because they use, number one, really crappy data sets, and number two, always lagging indicators, and number three, it's run by academics. So you've got, PhDs from all of these leftist institutions, because let's be honest, all of the elite institutions in the United States are far left. All of them, every single one. And so you've got basically like leftist academics running the Fed. And now we've got Kevin Warsh. He is not a leftist. And so it'll be really interesting to see how he changes things.
They use theoretical formulas, like dynamic stochastic general equilibrium models, to steer employment and inflation. Warsh relies on a different dashboard. His banking background trains him on real-time market signals, corporate credit spreads, and liquidity metrics. Watching the market, he deletes explicit forward guidance. Instead of telegraphing rate moves to handhold Wall Street, Warsh prefers strategic ambiguity. We saw this market-centric approach during the 2008 global financial crisis. Warsh bypassed standard models to act as the Fed's primary liaison to Wall Street, personally orchestrating emergency structural interventions for Bear Stearns and AIG. His willingness to support those taxpayer-funded bailouts reveals a strict boundary. In his policy philosophy, there is a clear distinction between a natural business cycle recession and a contagion-driven panic. For a standard recession marked by falling employment and cyclical pullbacks, Warsh demands rigid adherence to standard arithmetic formulas. He only sanctions overwhelming emergency liquidity when a true panic destroys market function and capital. This means the so-called Fed put, the expectation that the central bank will rescue falling asset prices, is moving deep out of the money.
Ooh, that's not good. Markets are not going to like that one bit. So the Fed put, basically, whenever markets pull back, or at least since 2008, 2007, 2008, and really before that too. There's always been a Fed put. You could say that there was a Fed put in the 1980s after the 87 crash. You could say that there was a Fed put after long-term capital management, LTCM, blew up in 1998. You could say that in 2000, there was a Fed put. And of course, in 2007, 2008, there's a Fed put. There's always this lender of last resort. But the lender of last resort, the Fed, has become the lender of first resort. They're the ones always stepping in with liquidity at the first sign of any type of equity market weakness. So if there's some type of a 20% pullback in stocks from these all-time highs, and the market senses that, hey, the FOMC chair, Warsh, is not going to step in and help us, that Fed put is really, really far out of the money, well, markets could really accelerate to the downside, especially since we've been going straight up. So, markets are a forward-looking mechanism. And if they start to sniff out that all of this AI capex by these hyperscalers is just not going to generate an ROI 6 or 12 months from now, then those stocks are going to get sold hard. Here's why they haven't gotten sold hard yet, though, because their earnings have been blowing it out of the water. When you see these big multi-trillion-dollar companies, beating estimates and then raising guidance, that is not a recipe for markets to roll over and move lower. That's a recipe for markets to pump much, much higher. And since these indices, the S&P, the NASDAQ, the Dow, they're made up of basically like a handful of companies now drive the majority of returns in these indexes. It basically means that the market is 7 companies. That's what it means. And so if those companies ever roll over and earnings start to contract, well, then we would be in for a wild ride, especially if that Fed put is much, much, much lower. So this is interesting so far.
Standard cyclical downturns will face a highly disciplined, intervention-free Federal Reserve. Looking at the Fed's current setup, Warsh views the massive $6.7 trillion balance sheet as a dangerous market distortion. He considers it a remnant of a bygone crisis era and an overstep into fiscal policy. His strategy is QT for rate cuts. He accelerates quantitative tightening to drain asset holdings, which tightens financial conditions. To offset this, he simultaneously slashes the short-term federal funds rate. Executing both at once drains private sector liquidity to dangerous minimums, carrying acute systemic risk. If reserves fall too low, it destabilizes overnight repo markets. A sudden freeze here strips the central bank of its fundamental ability to function as the lender of last resort. By attempting to conceptually tighten long-term conditions and ease short-term rates at the exact same time, Warsh risks mechanically breaking the core plumbing of the U.S. financial system. This raises an immediate operational question. How does an inflation hawk justify cutting the federal funds rate when headline inflation hovers at 3.3%? He relies on a methodoman. Warsh plans to move the Fed's mathematical focus away from traditional core PCE and toward alternative metrics, specifically trimmed mean and median inflation. Trimmed mean inflation excludes extreme outliers. By switching to this equation, Warsh subtracts real-world price spikes caused by global tariffs or the Iran war. Once filtered, he factors in a second justification, a massive disinflationary productivity shock from artificial intelligence. Macroeconomic analysts identify a severe structural flaw in this logic. Warsh is pricing AI strictly as a future supply shock that lowers the cost of goods via automation. But the current physical implementation of AI is actually a massive positive demand shock. Trillions flow into data centers, physical semiconductors, copper wiring, and energy infrastructure, actively driving up immediate raw material costs. Anchoring the federal funds rate to a single point estimate of unproven technological timelines leaves the Fed vulnerable. If the predicted productivity surge fails to materialize before the immediate demand-driven inflation takes hold, the central bank risks repeating the transitory inflation miscalculation of 2021. When Warsh attempts to implement these workarounds in the summer of 2026, he will trigger a fierce institutional rebellion from inside the Federal Open Market Committee. His primary structural roadblock is his predecessor.
Look at that fucking guy. Why did he decide to stay on? That hasn't happened in 50 years. And the last time it happened, it was at the behest of the then president at the time.
Yeah.
And this time, the president...
honestly, I think it's a political move. I honestly think that with the midterms coming up, that it's a play. And he has serious Trump hate. I mean, just the way that Trump has made him look, on camera. I'm sure his ego is just crushed. Like, when they had hard hats on,
yes.
And he was going through the offices and was just, basically picking it apart and talking about, the overages and all that. And he's like, oh, I don't know if that's Powell. I don't know if that's the case. He's like, oh, I got the numbers right here. Here you go. Take a look. And he's like looking at it and he's just shaking his head, has nothing to say because, it, like every government project, there's always millions and millions of dollars of overages.
Oh man! So here, let me see if I can dig up that photo. I think I found it. Let me see. Let's just take a look at this picture real quick, because this is kind of funny. I found it over here on some random publication. I just wanted to see his face. Huh? Oh, what is that? Huh? What am I looking at here? Where's my horse?
Yeah,
Dorothy.
I think
What year is it?
that's exactly it. Like he doesn't know, like he hasn't been briefed a million times on the budget and the overages and all of that. It's like to act like you don't know what's going on is freaking ridiculous. And
And
if he
how
doesn't, then he's grossly inept and shouldn't be doing the job that he's doing
and honestly, how in the world do you justify spending over what, $2 billion on a
on an
building?
office.
On
Yeah,
an office? What?
yeah,
What?
it's
How does
ridiculous.
that make sense?
I
With
want to know who I
historical
want to know
tradition.
whose cousin is the contractor.
That wouldn't surprise me at all.
Jerome Powell has firmly committed to serving out his statutory term as a standard governor until 2028. Powell anchors an entrenched bloc of institutionalists, alongside hawkish regional presidents. If Warsh proposes preemptive rate cuts to appease the executive branch, while real-world inflation remains elevated, this voting bloc holds the power to outvote the chair on his own committee. This internal power struggle is compounded by a severe ethical controversy. Warsh's financial disclosures reveal over $100 million in illiquid, heavily redacted private partnership stakes tied directly to billionaire macro investor Stanley Druckenmiller. Warsh's aggressive quantitative tightening program naturally steepens the yield curve. That specific mechanical action directly expands bank net interest margins, artificially boosting the value of his former partner's massive bets on the financial sector. These competing macro forces.
So, just as an aside, I'm pretty sure that Druckenmiller is a big bond bear. So that means he's bullish on rates, bearish on bonds.
Will inevitably collide. The accelerated QT program will drain banking reserves to the point of structural scarcity, triggering a sudden collapse in market liquidity and violent equity volatility. If Warsh holds to his recession versus panic distinction and refuses to support equity markets during a standard cyclical downturn, he will be acting against the explicit demands of the administration that appointed him. This moment will test whether his stated commitment to institutional restraint can
Uh-oh. It cut off at the very end there.
Oh no.
But that was kind of interesting, though. Let's just see if there's maybe a little bit more information here about the new FOMC chair in this slide deck. Okay, so an M&A mindset. It seems as though he's gambling on AI policy, at least from this piece of research. Apparently, there are some unprecedented conflicts, and there's definitely going to be some type of a civil war within the FOMC. So that's interesting. We got the end of the academic era, and thank goodness for that, because I'm so sick of academics with no real world experience building anything, dictating policy for these industries. So it'll be interesting to see how a financier as FOMC chair will act differently than an academic. Let's see here. We've got a dual pedigree. So he spent a lot of time at Morgan Stanley. Well, 4-6 years is not that much time, actually. And then it says here he was on the National Economic Council and did, have something to do with, the intervention in 2008. Let's see here, operational supremacy. So that's a little bit about Warsh. I want to see if we can move on here. And we've got some content about the dot-com boom and comparing that to the AI boom. So dot-com bubble, comparing that to the current AI boom. And then we've also got some information here about Bitcoin's macro sensitivity to inflation and those CPI prints. So I kind of want to play the Bitcoin content here about CPI. I think that this could be pretty interesting. This is one of those older pieces of Notebook LM content, but since we've got CPI tomorrow, I think this could be valuable. So let's go ahead and learn a little bit about Bitcoin's relationship to CPI.
Hey everyone, and welcome to This Explainer. Today, we're diving into something absolutely fascinating, how Bitcoin transformed from, a retail speculation toy into the ultimate global liquidity barometer. Seriously, if you've been watching the markets lately, you can feel that the landscape has totally shifted. We're no longer just talking about a decentralized network. We're looking at a macro asset that sits directly downstream of global monetary policy. Let's get right into it. Instead of just walking you through a boring agenda, I want to start with a question. It's actually the exact question that defines modern crypto trading. What actually happens when the clock strikes 8:30 a.m. Eastern Time on inflation data days? If you've ever had your eyes glued to the charts at that precise minute, man, you know it is definitely not for the faint of heart. The Bureau of Labor Statistics drops the consumer price index, and bam, the market just instantly goes haywire. And that brings us to this beauty right here, the Darth Maul candle.
Oh my goodness. Have you ever heard of this before, Mike?
I've never heard of a Darth Maul candle.
I've never come across this term in my life. It says, it's an explosive symmetrical wick that liquidates longs and shorts before a trend starts. Huh. Interesting.
Learn
Yeah.
something new every day.
I know, right?
This is an explosive phenomenon that just whiplashes traders in both directions instantly. Picture the double-sided red lightsaber from Star Wars, because that is exactly what the chart looks like. Literally within seconds, the price wicks violently up and down. It's just hunting and liquidating over-leveraged swap positions on both the long and the short side, well before the market even decides which way it actually wants to go. It is brutal. So, moving on to Section 1, the CPI reaction playbook, asymmetric returns. Look at this asymmetric return profile here. This is looking at the very first hour right after the data drops. When inflation comes in hot, meaning it's higher than expected, it literally slams the price down. We're talking an average immediate drop of 0.72%. But check out the flip side. A cool print triggers immediate bullish momentum, jumping up an average of 0.63%. The takeaway here? This asset is hyper-reactive. It is pricing in macro data instantly. So, what this table essentially proves is that the market is actively anticipating the data. Let's kind of walk through the timeline. In the 24 hours pre-release, we see a deleveraging bias if folks are terrified of a hot print. Then, in the 1 hour reaction window, boom, we get that crazy sell-off or a fast upward break. By the 4 hour mark, funding rates start to compress, and you might see short sellers getting squeezed out. And finally, 24 hours out, we hit either maximum drawdown or a full-on relief rally acceleration. It's like a giant puzzle. The market prepositions, reacts violently at the print, and then eventually settles into a real trend based on what the Fed might do next. All right, Section 2, the Darth Maul effect, intraday microstructure flow. So how does this actually play out behind the scenes? The chaos unfolds in 4 exact microstructural steps. Step 1 is quiet compression. Volume and volatility just completely dry up right before 8:30 a.m. It's literally the calm before the storm. Step 2 is an explosive market expansion the exact millisecond the BLS publishes the data. Then, step 3, this is where the real pain happens. Violent, double-sided stop running and liquidation cascades. This is the Darth Maul wick basically incinerating the highly leveraged traders. And finally, step 4 brings true directional discovery. Once the leverage is flushed out, a sustained trend finally takes hold based on the real data. Moving right along to Section 3, 3 eras of evolution, how Bitcoin became a macro instrument. This timeline basically maps out the incredible journey of this asset. We start all the way back with Phase 1, the zero interest rate, quantitative easing days of 2020 to 2021. Then we slide into Phase 2, which was the super painful, aggressive Fed tightening cycle of 2022 to 2023. And that lands us right in Phase 3, our current reality from 2024 to 2026, rate normalization and full ETF integration. Now, think back to Phase 1. Immense global quantitative easing and zero interest rates just dramatically expanded the M2 money supply. Basically, they flooded the system with cash. Genuine fiat debasement fears sparked this massive spot accumulation, and that really birthed the whole digital gold and inflation hedge myth. I mean, the asset's trajectory was insane. It pulled in a staggering 303% return in 2020 alone. Pair that with the third halving, dropping supply inflation down to 1.8%, plus a really weak correlation to traditional equities, and Bitcoin genuinely felt like this isolated, untouchable life raft. But then, Phase 2 hit and completely shattered that digital gold myth. Headline inflation reached a massive 40-year high of 9.1%. This forced the Fed to initiate its fastest tightening cycle in 4 decades. And, well, that rapidly dismantled the whole inflation hedge narrative. Instead of acting like gold, Bitcoin started trading in exact lockstep with highly reactive tech stocks. Its correlation broke way above 0.80. Hot CPI prints started triggering immediate, aggressive selling, which, eventually sparked those catastrophic systemic liquidations we all remember too well, like Terra Luna and FTX. To really put this wild history into perspective, just look at the rigorous math behind the asset. Over a 14-year period, it maintained a mind-boggling 147.6% annualized standard deviation, paired with a moderate Sharpe ratio of 0.78. Basically, what that means is the returns are solid, but you were taking on absolute roller coaster volatility to get them. It's the statistical fingerprint of a wild, yet structurally rewarding macro asset that, frankly, demands extremely precise risk management. Okay, let's jump into section 4, a new institutional reality, spot ETFs and macro integration. Take a look at this stark contrast in our current era. It's totally regime dependent. When we're sitting in a stable growth environment with low inflation, Bitcoin kind of just ignores the S&P 500. It has a super weak correlation, like 0 to 0.40. But, and this is a big but, flip the script to a macro stress environment, think geopolitical tensions or tariff fears, and Bitcoin suddenly moves in near lockstep with equities. The correlation spikes up into the 0.80s and 0.90s as broad deleveraging takes over.
Okay, so basically what it's saying is that Bitcoin doesn't really track equities on the way up, but it really does on the way down.
Reality today is that institutional spot ETFs completely dictate the flow. The reaction function is incredibly technical now. A cool inflation print? That guarantees risk-on capital rotation and drives massive positive inflows straight into spot ETFs. On the flip side, hot inflation prints trigger rapid technical de-risking. These major allocators are strictly forced to manage their value at risk limits, right? So they have to move coins onto exchanges, which results in net ETF outflows and pretty sharp price corrections.
And guys, this matters immensely for us right now. Why? Because the next critical CPI print hits tomorrow morning, May 12, 2026. Market consensus is bracing for a painful rise to 3.7% year over year, mostly driven by sticky energy pressures. You can literally feel the anxiety in the market because every single trader knows exactly what the algorithmic playbook is going to do.
So
Okay, so if we've got crude oil remaining elevated and rates ticking higher, and the expectation tomorrow is for CPI to come in hot, well, at what point are we going to start to hear, governors at the Fed using that word transitory again? Well, they're not. They're not. They're not using the word transitory. In fact, what they're talking about now is we need to start talking about rate hikes. That's what they're talking about now. And the Fed, with the Fed funds rate, it tracks the 2-year Treasury yield. And so if we see 2-year Treasury yields pushing higher after having broken out above trend line resistance, as they have, and we know that the Fed funds rate tracks the 2-year Treasury yield, it looks as though we should actually be bracing for a rate hike, not a cut. So that would likely not be a positive thing for any risk on asset. Rate hikes, I mean.
with the market bracing defensively and perpetual swap funding rates stuck in the negative for a decade-high 67 consecutive days, the tension is coiled tighter than a spring. We've got historical data, ETF mechanics, and the looming Darth Maul effect all converging exactly at 8:30 a.m. So I'm going to leave you with this to ponder. When the clock strikes 8:30 tomorrow morning, which way will the ultimate global liquidity barometer break? Thanks so much for joining me on this explainer, and seriously, keep your eyes on those charts.
Yeah, no kidding. So it's going to be interesting to see what happens with Bitcoin tomorrow. Okay, now that we've gotten through a little bit about the new FOMC chair, we've learned a little bit about Bitcoin's correlation with CPI inflation, and how Bitcoin trades after a cool print versus a hot print. Let's go ahead and take a look here and learn a little bit about the similarities, at least, between the dot-com bubble and the current AI boom. I think that this will be pretty interesting because, back in the dot-com era, Cisco was the manufacturer that I guess you could compare to NVIDIA nowadays. And we all know what happened back then. So is this time going to be different, or are we seeing a massive malinvestment of capital? Let's see what the explainer has to say.
The late 90s saw immense physical construction, thousands of miles of fiber optic cables. Today, we see a similar industrial effort, massive electrified GPU server racks. Looking at this scale of capital-intensive infrastructure building, many market participants assume we are living through a speculative bubble, destined to end in a devastating crash, exactly like the one in 2001. In 2000, Cisco's market cap peaked at approximately $560 billion. Today, Nvidia's has exceeded $3 trillion. Yet, layering the Nasdaq's explosive 1990s growth directly over the S&P 500's recent extreme top 10 concentration reveals virtually identical trajectories.
Uh-oh.
The psychological exuberance surrounding artificial intelligence heavily mirrors the late 90s internet boom, but the underlying economic engine driving this capital formation operates on a completely different architecture. To accurately evaluate the current tech cycle, we have to deconstruct four distinct macroeconomic pillars: hardware valuation, customer solvency, central bank liquidity, and the physical laws of infrastructure depreciation. What the data reveals is that the AI cycle is highly unlikely to end in a 2001-style implosion. Instead, it is marching toward a completely new structural threat, a $600 billion return on investment gap. In times of massive technological expansion, the most reliable capital formation happens at the infrastructure layer. The companies building the network capture the initial wealth long before the end-user applications figure out how to monetize it.
Right.
During the 1999 internet build-out, that monopolistic hardware supplier was Cisco Systems. Driven by a relentless pipeline of hardware orders, Cisco's equity detached from its actual earnings power. At its absolute peak, the stock traded at a trailing price-to-earnings ratio that ranged from 150 to over 470 times earnings, requiring decades of flawless future execution to mathematically justify. Cisco attempted to meet this demand using an asset-light virtual manufacturing model, heavily outsourcing the physical production of its routers to independent contract manufacturers across Asia. This created a severe operational blind spot. Terrified telecommunications companies, desperate to launch their networks, began double and triple ordering the exact same hardware from multiple vendors just to see who could deliver first. Cisco's forecasting software recorded these redundant phantom orders as legitimate exponential demand. When the capital markets froze and those telecom customers began going bankrupt, the phantom demand vanished. Cisco was left holding mountains of custom hardware that no longer had a buyer, forcing the company to absorb a catastrophic $2.25 billion inventory write-down. Now, look at the indispensable supplier of the modern AI era, NVIDIA. During its rapid ascent, NVIDIA traded at a trailing PE hovering between 50 and 80. While high, this valuation is strictly anchored to immediate net income generation and massive free cash flow conversion. Unlike the intense margin pressure of the open standard networking era, NVIDIA routinely maintains gross margins exceeding 70%. This profitability is protected by a proprietary software platform called CUDA, which creates immense switching costs for AI developers and heavily insulates the underlying silicon from rapid hardware commoditization. Cisco's peak valuation required deeply flawed forecasting of open standard hardware orders. NVIDIA's current valuation relies on verified, mathematically precise revenue streams secured by tight software integration. To understand an infrastructure boom, we must examine the balance sheets of the customers actually buying the hardware. In 1999 and 2000, approximately 86% of the technology companies going public on the Nasdaq were operating at steep net losses. Capital was flowing indiscriminately to entities with extreme cash burn rates and zero-margin logistics models, famously symbolized by multi-million-dollar ad campaigns for pet food delivery startups that ultimately collapsed into bankruptcy within months. Today, the demand for AI infrastructure is highly consolidated. NVIDIA's primary customers are the four major hyperscalers: Microsoft, Meta, Alphabet, and Amazon. These are mature monopolies generating hundreds of billions of dollars in aggregate free cash flow. They possess the immense balance sheets required to absorb initial infrastructure losses and sustain capital expenditure over a multi-year horizon, even if the application layer struggles to monetize immediately. This chart illustrates the modern structural risk this dynamic creates. The top 10 companies in the S&P 500 now account for approximately 41% of the total index weight, a level of concentration that far exceeds the year 2000 peak. The 2001 crash was triggered by a systemic wipeout of heavily leveraged, insolvent customers. The modern market will not suffer a widespread insolvency crisis, but it carries the precarious risk of relying entirely on a handful of mega-cap balance sheets to sustain a single thematic outcome. The survival of any debt-reliant technology sector is ultimately dictated by the central bank's cost of capital. During the peak of the dot-com euphoria, the Federal Reserve became
Hey, David.
highly concerned about an overheating.
What's that, Mike?
I gotta sign off. They're about to cut the power, so I want to make sure I power everything down properly. But yeah, just if you haven't already, if you could please like, share, follow the stream on Arena and on YouTube X, all that. We do this daily, Monday through Friday. So we're all about giving you good quality content here. But I appreciate you filling in for the last little bit, David. That's I just
You got it.
That's the problem living out here in the boonies is they're always working on the power.
All good, man. All good. We'll go through the rest of this content and then we'll finish up with some technical analysis.
Sounds great. I'll talk to you soon.
Thanks, man.
Yeah.
Economy and wage inflation. Between February and May 2000, the central bank executed an aggressive tightening cycle, ultimately pushing the benchmark federal funds rate to 6.5%. This sudden, deliberate spike in borrowing costs immediately starved the cash-burning internet startups and triggered a massive default cycle among telecommunications providers who relied on constant debt refinancing to lay their networks. Now, observe the current macroeconomic environment overseeing the AI infrastructure build-out. While the AI cycle initially ignited during a tightening phase, the broader infrastructure sprint is now occurring against a backdrop of actively loosening monetary policy. By 2026, the Federal Reserve pivoted to a definitive easing cycle, cutting the federal funds rate down to a target range of 3.5 to 3.75%. Decreasing borrowing costs drastically reduce the immediate threat of a capital cost-induced systemic shock. The primary pin that popped the heavily leveraged telecom bubble has effectively been removed from the current equation. The final structural divergence lies in the actual physical laws of depreciation governing the hardware being built. In the 5 years leading up to 2001, the telecommunications industry laid 10 million route miles of permanent glass fiber optic cable across the United States. Glass embedded in the ground does not rot or rapidly degrade. When the telecom companies collapsed, this unlit dark fiber remained perfectly intact, creating a permanent supply overhang that paralyzed new networking hardware sales for a decade. Contrast that with the physical reality of a modern AI data center, operating tens of thousands of specialized graphics processing units. High-end silicon operates on a highly truncated lifecycle. A specialized GPU is typically rendered technologically obsolete by the next generation of chip architecture within roughly 2 to 3 years. Because the absolute physical bottleneck of modern AI is the electrical grid, older, power-inefficient GPUs simply cannot be economically utilized to train next-generation frontier language models. This rapid decay ensures a continuous hardware replacement cycle. Overinvesting in data centers today will not create a permanent dark fiber-style capacity glut that destroys future demand. The systemic risk of the artificial intelligence boom lies in the sheer crushing industrial scale of the capital now being deployed. Big tech is currently locked in what analysts call the game theory of AI capex, an environment where the strategic risk of underinvesting and losing platform dominance far outweighs the financial penalty of overinvesting. This existential fear has escalated the infrastructure arms race to staggering heights, with combined annual capital expenditures projected to reach up to $725 billion by 2026. As these capital expenditures increasingly outpace internal free cash flow, hyperscalers have been forced to pivot. They are now issuing massive tranches of investment-grade corporate bonds, shifting from cash-rich expansion to debt-funded infrastructure development. To justify the $300 billion total capital cost of an AI data center ecosystem, assuming a 50% gross margin requirement, the industry must generate $600 billion in annual revenue. Current software revenue falls hundreds of billions short of this required payback. If highly monetizable enterprise and consumer applications do not materialize at a scale sufficient to bridge this gap, shareholders will inevitably force the hyperscalers to severely curtail their capital expenditure budgets.
A sudden capex contraction of that magnitude would trigger a severe valuation compression across the entire semiconductor supply chain. The AI boom is anchored by the most profitable, cash-generative monopolies in financial history. It rests on solid economic rock, rather than speculative sand. But it is building a leveraged financial structure of extreme vertical height, and the higher it builds before the software layer can successfully monetize, the greater the kinetic energy of the result.
Yeah, so the bottom line for me is this piece of information. Let me just back this up a little bit and see if I can find it for you guys. Let's go ahead and just back
The
up
late
the video
90s.
here real quick. I want to see if I can find it. I think it's right around here. There was an interesting chart in here that shows the gap between what's being spent to build out all of these data centers and how much revenue the applications are actually generating, based on all that spend. So if there's a huge gap, eventually shareholders are going to care about that, and the markets are going to price that in quickly. So I think it's right here. Let's go ahead and play it here.
Expenditures projected to reach up to $725 billion by 2026. As these capital expenditures increasingly outpace internal free cash flow, hyperscalers have been forced to pivot. They are now issuing massive tranches of investment-grade corporate bonds, shifting from cash-rich expansion to debt-funded infrastructure development. To justify the $300 billion total capital cost of an AI data center ecosystem, assuming a 50% gross margin requirement, the industry must generate $600 billion in annual revenue. Current software revenue falls hundreds of billions short of this required payback.
Okay, so this is the bottom line for me, this ROI gap. How in the world does this gap get filled? Like, how does this make sense? How is it that, as a hyperscaler, you can spend hundreds of billions of dollars and even start to borrow, levering up your cash flows in order to be able to build out more AI data centers? How does that make sense if there's no return on that investment? Like, if you're spending $600 billion to make 20 billion, make that make sense. Eventually, shareholders are really going to care about this. And I think right now, this is just being ignored, which is no bueno for markets. Eventually, this is going to matter. And so here's something else that I've been thinking about a lot. Eventually, this is going to matter too. So what this is, what I'm sharing with you guys here is, this is the 2-year treasury inverted. So this is the yield on the 2-year treasury. And so if this is breaking out, and we know that the Fed funds rate is positively correlated with the 2-year. So if we see yields at the very front end of the curve pushing higher, breaking out above trendline resistance, trading above the 200-day moving average, and actually potentially breaking out, well, that means that we should be expecting the Fed to hike, not cut. So that's kind of interesting there. But why don't we take a look at the performance of some of these indexes? So here's the NASDAQ. This is a daily. This is the NASDAQ on a daily, and this is vertical, going straight up. So this thing doing nothing but up only. The S&P also breaking out. The S&P broke out above trendline resistance, up only over the last 6 weeks or so. Same thing with the Russell, just maybe to a little bit of a lesser extent. Now, these are all more interest rate sensitive items. And then if you pair that with volatility actually collapsing and mean reverting back down to its 200-day moving average here, it's starting to look to me like owning some downside tail risk puts is actually cheap. It's cheap to own protection to the downside with these equity indices at all-time highs going straight up only. Let's take a look at some of those underlying items. Here's Tesla. So Tesla, up at plus 3% today on the session, trading back above that 200-day moving average. And Tesla did hold well above trendline support, never actually even got down to test that trendline support before reversing higher. Google got rejected off of $400. I think the all-time high was $397, it looks like. So Google, basically just straight up over the last couple of weeks here. This is a massive move, but there's some gaps. So this gap, that's a pretty interesting level. So maybe if there's some type of dip, you might be able to pick up Google at 355. NVIDIA, fresh all-time highs today for Nvidia, and trading well above that 200-day moving average again. This thing, it could definitely even continue to run from here. This is, I think, now the largest company in the world, far and away the largest company in the world by market cap. Microsoft, one of those big hyperscalers, put in, this is referred to as a false breakdown, and now back up above this level of trend line, what is now support. So Microsoft, though, trading well below its 200-day moving average. I'm not quite sure if they've started to borrow to lever their cash flows to enter to get even a larger share of that AI data center build out or not. I think they've actually started to do the opposite and cancel some contracts. I think the reason why they've been canceling contracts is there's no power. They can't power these data centers. Take a look at Apple. Apple does not have all of that AI capex spend. Now, Apple just signed a deal, or I think they just signed a deal with Intel to diversify their chip manufacturing pipeline. And so Apple, printing some fresh all-time highs today, trading well above that 200-day moving average. Amazon, up only for the last couple of weeks here, breaking out above trendline resistance and trading at fresh all-time highs a couple of sessions ago. So if we're going to see a retest of support, expect Amazon to test 260. Meta. So Meta has been borrowing heavily to lever its cash flows and get a larger chunk of that AI data center build out. So here's the 200-day moving average for Meta. Notice after we bounced off of trendline support here, got rejected at that 200-day moving average and then gapped down after reporting earnings. So if Meta moves to the downside just a little bit further, expect support to come in at 547. And Oracle, this is again, big software player, but also, they've been borrowing heavily to get a piece of that AI data center market and didn't even manage to make it up to the 200-day moving average, which comes in at 210. If you think there's going to be a little bit more upside out of Oracle, expect resistance to come in at the 200-day up there at 210. Now, we've got to take a look at Bitcoin, Ethereum, Solana, and a handful of other digital assets here, because there have been some really, really big moves to the upside just over the last couple of days, couple of weeks here. We need to start things off, though, by taking a look at Bitcoin. And I want to grab my arrow tool, and let's just take a look at this together. So this is where Bitcoin's currently trading. Notice that moving average there? You see that moving average? That's the 200-day moving average. It looks pretty similar to what we had last bear cycle. So if the bear is over for Bitcoin, this would be, number one, the shortest bear in terms of number of days, and it would be one of the shallowest troughs in terms of the drawdown from the all-time high during a Bitcoin bear market. So if you think this time is different, well, then we would need confirmation. We would need a breakout above that 200-day moving average. And really, we would need to see Bitcoin trade above 98,000 for the bear to be canceled. But there's a couple of quite bearish patterns here on the chart, longer-term patterns. This is referred to as an ascending wedge. Ascending wedge patterns are very bearish price action patterns. We've also got this bear flag. So you've got the ascending wedge, you've got the bear flag, you've got resistance at that 200-day moving average. We're still squarely within a Bitcoin bear market according to the cycle anyway. And if Bitcoin were to fall out of this ascending wedge pattern to the downside, well, then that could potentially mean the pattern would start to complete. And you would expect Bitcoin to then move all the way down here to 50K or maybe even 47, something like that. That would be the target for this pattern. So this is a bearish price action pattern within another bearish price action pattern at resistance. But because Bitcoin has ripped and, well, ripped from that 65K low that we saw at the end of March all the way up, just yesterday to 82.5. So because Bitcoin has, pushed to the upside like this and consolidated its gains, we've seen a lot of alts really start to push higher also. So take a look at Solana. Solana today barely breaking out, almost breaking out. So it has technically broken out, above this level of resistance that came in here at $97. So seeing Solana push to the upside like this, that's interesting. And it tells me that maybe if we continue, if this breakout confirms, watch that 200-day moving average as a level of resistance. If we zoom out here and take a look at Solana last bear market, what it did was it rallied all the way up to that 200-day moving average last bear. That was a really sharp rally. So if this is still a Bitcoin bear, then we should expect face-ripping bear market rallies. And that means maybe we see another, 15 or so dollars on the upside for Solana. Now, Ethereum has been the laggard here. And I was reading in the Node newsletter earlier this morning that there was a massive whale that deposited like 500,000 ETH on an exchange. I don't know if that information has been verified or not. I would have to independently verify that. But ETH, this is a bear flag. This is like a textbook bear flag out of ETH with resistance up here at the 200-day moving average. They call it 2,700, but you've also got trendline resistance up here. So you've got what's referred to as a confluence. So 2,650, if ETH is able to push a little bit higher, 2,650 would be significant resistance for Ethereum. Now, if we take a look down the list at some of the higher volatility altcoins, here's Sui. Sui, big move the other day. I think it was plus 30% and all the way up to that 200-day moving average. So here's the thing. If these are bear market rallies, then you would sell these. Bear market rallies are for selling, not for buying. You don't want to chase a big move like this during a bear market. So at least not in the 5th or 6th inning of a bear market. If it was September, sure, then maybe I would be buying this. But it's not September. It's the beginning of May. So this is a really nice move out of SUI. Resistance at the 200-day moving average, though. So I continue to believe that bear market rallies are for selling. XRP. Now, XRP is starting to break out above trendline resistance here. It's got 200-day moving average resistance up at $1.75. So if XRP puts in a pump to the upside, it would be a great sale at $1.75. Here's Arbitrum. This one put in a little bit of a cup with a handle pattern, cup with handle, a little bit kind of sort of. And you've got, that 200-day moving average resistance coming in at 16.7 cents for ARB. If this one is even able to get up there, I would be surprised. But if it does, I would sell it at the 200-day. Here's Aave. The Aave token just perking back up a little bit, not really putting in much of a rally. Here's BNB. So BNB has some, just like a level of horizontal resistance here at 687. But this is a very well-defined bear flag. So get a little bit higher out of BNB. BNB is a sale at around 690, let's say. Arrow, the Arrow token. So Arrow having broken out above that 200-day moving average, following the trend line on the way up, bouncing off of support at 27.5 cents. Arrow could actually send quite a bit higher if it can hold on to the 200-day moving average. Take a look at some higher quality alts. Here's Tau. So BitTensor Tau, we've got trendline resistance up here at 410, but even if it's able to get up to 410, that would just be a lower high. So we've got a high, a lower high, make it up to 410, that would simply be just another lower high. Hype, the Hyperliquid token, just tracking that trendline support on the way up, trading well above that 200-day moving average. Let's see if this holds. If it does and it pushes higher, 45.90 on the upside, a break above that, and we could start talking about $60 for Hype again. Here's Tron. Tron has been really outperforming most other digital assets recently, and pushing up here at 35 cents or so. We could see Tron, if it breaks out above 37 cents, I would consider that to be a fresh all-time high because I kind of ignore the wick. I don't think there was a whole lot of trading activity on that wick. Take a look at something like Toncoin. So, this is kind of the pattern that I expect from these alts. Here's the all-time high, a lower high, and this is just a lower high. Really big move, but giving back quite a bit of it. And if we just zoom in here a little bit, it is starting to flag off that's bullish. So this is the pole. This is the start of a flag. So importantly, the bull flag has to be downsloping. The bear flag has to be upsloping. So if this were to push a little bit higher, watch for $3.60 to be resistance on the upside for TON. Okay, we've run out of time. I really appreciate everyone for joining these calls live. If you want to support the Node network, then hop on over here into the node.pro, our official website. Take a look at all of the programming so that you can never miss any of your favorite shows. All of the course content is no charge. So if you want to hop in here and build a skill set, you can do that whenever you'd like to. Our communities, I've been working on this a lot recently. We've got DeFi University on School. We've got the Node Network on our Discord. And pretty soon you'll be able to join these not daily, they're 3 times weekly. So Monday, Wednesday, and Friday, Google Meets calls where you can hop on with me and we can discuss markets. I go through all of the research that I produced during the regular session and then find actionable opportunities. So if you want to join those paid calls, you can absolutely do that. But these communities are also no cost. Private coaching, if you want to build a crypto and DeFi skill set and avoid making costly mistakes, then go ahead and book some time with me. I'd love to talk to you. Our newsletter is almost done, almost there. It's going to be done, hopefully over the next couple of days. It already has proven to be very valuable, just getting this in my inbox every day before and after the market opens and closes. And here we go. This is our store. So I just got a couple pieces of merch that I threw up here, and we're going to be really improving the designs on all of this stuff. This is just kind of like a template for right now. But if you want to support us, those are the ways to support us. And of course, please make sure to like, follow, share, and subscribe. Thanks so much, everyone, for joining this call live. And we've got another call immediately after this one. I think it just started running. That's the blockchain report, Jeff's pre-recorded session. And then later on today in 2 hours, we've got the daily market wrap, where I'm going to spend 15 minutes going through the biggest charts of the day. And then tomorrow, we run our regular show again at 9 a.m. Pacific, 12 p.m. Eastern. Thanks, everyone, for joining live, and see you guys on the next stream.